Hello, everyone. My name is Srinath Reddy. I'm one of the founders here at Intentwise. Intentwise is a technology company, and we provide two solutions. One is an ad optimization platform, and another is a data and analytics platform for Amazon and retail media. And today, I have the pleasure of hosting Daniel Tejada. He's one of the founders at Straight Up Growth, which is a fast-growing San Diego-based Amazon agency. Great to have you, Daniel.
What's up, Shreyas? How you doing?
You've got a fan following in my house. I shared your LinkedIn post with your dogs, and they want to be best friends with you now.
Yeah, got dogs for days, that's for sure.
So you got what, 4 pets?
Yeah, I've got 4 dogs, 15 legs is the joke I say, because one of them is a tripod, but it came like that. It wasn't after beating me. So
great to have you here. Why don't you take a moment, Daniel, introduce yourself, introduce Straight Up Growth.
Yeah, so my name is Daniel Tejada. I'm one of the founders here of Straight Up Growth. We are a Amazon-focused growth agency, really working on getting some straight up growth. Manage like 35 million in spend. We'll do about 350 million this year on Amazon. So yeah, definitely excited to chat. Then just for me, I'm doing Amazon ads since like 2016. I've spent over $50 million on Amazon ads. I've done a little over $500 million worth of product on the channels.
We have you here today to talk about an important topic, which is inflation in average CPCs across the board. Just to set the context for today's conversation, I just want to bring up a couple of visuals. One of the benefits we have at Intentwise is, we see a ton of spend go through the platform. Here's a view across over $300 million of spend. You can see kind of average CPC trend throughout this year. And one unique way we look at is, looking at sponsored product top of search placement, right? So that is kind of, I think, a nice benchmark to really see what's happening to CPCs. So this is an aggregate view, and you can clearly see a 30 to 40% increase over time throughout the year. So that's the context in which we're going to dig deep today. So Daniel, let me open this up by asking kind of, what are you seeing? Does that trend jive? Any comments?
Oh, yeah. No, I think CPC inflation this year is the highest amount of CPC inflation I think I've seen on Amazon since I've done this. Amazon basically doubles their ad business every year. It's just something I've seen since I started there. But I've never seen CPC inflation like I did this year. This was definitely the fastest percentage increase, I'd say. I mean, your chart, you said like 30 to 40%. I know I have read like in Q2 in particular, I noticed on that first chart, you see like an extra acceleration on those CPCs themselves. I've read a couple articles that were talking about Amazon having like an average of almost a 50% year over year increase across all levels, so not even including the top of search. I do think, especially for top of search specifically, that's where I've seen an even greater increase from a CPC perspective. I think what's happening, that why certain clients like maybe haven't had as big inflation as others, is Amazon's just trying to push ad placement as hard as possible, and they're stretching. So a lot of those search terms that like even in an exact match type, let's say, that typically you get top of search, your CPCs may have not inflated that much. But what I find when you're kind of running in the account is you'll see you're moving from those top of search placements, and now it's a heavier allocation towards rest of search placements, which can still be valuable, but definitely perform differently. So that it's definitely a tricky situation we're in right now.
It is, and my team put out a funny caricature. Let me bring it up. Here it is.
Oh yeah.
You've got CPCs going up, and of course we all know the issues on the shipping side. So shipping costs are up as well. It's a bit of a double whammy right now. Any kind of thoughts on kind of big drivers behind that increase in CPCs?
Yeah, so I think a couple things. I think COVID in particular accelerated, the adoption of Amazon, not just from customers. I mean, obviously it captured even more market share during that time frame, but really from brands themselves as well. Yeah. So I've, over the past few years, my journey with getting ad budgets, for example, from clients has changed significantly, right? Bigger brands, if we're talking 2017, barely cared, right? Just flip on the radar. 2018, some of them started to recognize, the growth potential there. So there was definitely some acceleration from a spend perspective, but you were fighting for budget usually, even with that brand from other places. Yeah. Where when I'm looking at it from 2020 and then especially 2021, Amazon went from being like the afterthought to the main focus for a lot of these brands, these main brands. Growth targets for brands were starting to be based around Amazon and no longer just their .com and their retail presence and things like that. So I think from that alone, we've definitely seen a humongous influx of ad dollars. And the other piece that I'm also seeing on my end is I feel like Amazon's user growth is flatlining a little bit, right? So historically, Amazon's still working towards growing the amount of people that are Prime members. So their search volumes would grow pretty significantly with the ad dollars. So we'd see some inflation, but not as large. What we find now, I think I've read that Amazon has almost 200 million Prime subscribers in the US, right? They did last year 60% more revenue than the next 10 biggest online retailers combined, right? Not, so essentially what I'm seeing is the supply of searches, I believe, is actually starting to flatline. Amazon doesn't give you exact volumes, and so you get search frequency ranks. But my theory is that they've captured as many customers as they can, but demand for ad dollars has continued to increase. So if we're just doing a basic demand curve graph, we finally reached the point where supply is constrained in comparison to demand, and that's why we're seeing that massive inflation. Definitely a big piece. What are your thoughts?
And I think if you look at what happened with Google and Facebook CPCs too, I mean, they went up quite a bit from the time where they started. And I think there is that part of natural progression increase that is to be expected. And to your point, COVID probably accelerated a bunch of things, increased e-commerce share of existing players and a bunch of new players coming in.
And the other thing I'd say too, honestly, while Amazon's seeing these massive increases, to CPCs, and it definitely impacts return on ad spend, I would also argue that Amazon was artificially low, right? It was so inexpensive to get impressions, like especially in comparison to something like Google. Google, has already been out for 10 years plus, right, on the ad side of things. So there was that, I call it, the golden days where everything's so inexpensive, but eventually demand catches up, right? Especially when you see how easy it is, or it could have been. So I think even with where we're at right now, I do expect CPCs to still continue to go up over time. I don't think we've plateaued there. But I also think Amazon's even recognizing it, right? And there's a reason why Amazon's pushing all these additional ad units and ad types and things that didn't exist in the past. And I think it's because just your standard search, your sponsored product, sponsored brands, you're starting to run out of inventory, essentially.
And then, talking about new players entering these auctions, it's hard not to talk about aggregators, right? So what's the number? So they've raised, in aggregate, I saw a number on Market Pulse, it's $10 billion has been raised. And then this week, Thrasher raised another billion. So obviously, there's that impact. So what's your take on impact of aggregators on CPCs?
So aggregators, just like the way I think of, like traditional CPGs getting into Amazon and really dedicating a lot more budget on that front, really have the same type of impact, right? They're able to grow with budgets that are way beyond what typical brands were spending, right? In the past, like when I was doing this like 2017, a big budget for me was like 200 grand to 300 grand. Get wild, maybe you have like 500 grand, like a month budget. You have brands like this or aggregators and these big CPGs, that's pennies to them, right? So they're coming in with, we want multi-million-dollar buys. Their goals are different too, right? So if you're smaller, a lot of times it's growth, but you've got profitability, you've got cash flow to worry about. With some of these bigger folks that come in, I get a lot more of, I want to be number one in this category. How much money do I need to spend? And I'll throw a number in their face that I think is ridiculous. And they're like, done, let's go. So that is where I think we're also definitely seeing a huge amount of that. It's also really interesting when that ad inflation started to super accelerate, which was Q2 of this year.
Yeah.
Really Q1 and Q2 of this year is when you started to see all this money going into aggregators, right? Thrasio kind of set the bar and sort of made it a big thing, but all of a sudden, I remember Q1, Q2, I was reading funding articles all the time, like boom, 500 million for this aggregator, $1 billion here. I'm just like, whoa, maybe I'm doing the wrong thing right now.
Yeah, and I even wondered, like, if the supply constraints were a lot less, what would this look like, right? So it'll be interesting to see what happens as hopefully these supply constraints go away. But as they go away, curious to see what happens to competition in the space. So what do you expect to see, especially on the CPC front, next 3, 6, 9 month horizon? Any thoughts on that, Daniel?
I don't think we're going to accelerate as quickly. So like, even if you look at that first chart you had done, we saw a really big spike, Q2, Q3 there. It started to flatline since. It's still increasing, and I think we'll still see a consistent growth from our average cost per click in general. But I don't think that we're going to see the same types of spikes right now. There's a couple of reasons why. One, as it gets more expensive to advertise, a lot of brands still have some targets that are super focused on things like return on ad spend, right? And so that's naturally going to depress the demand on some of those higher volume search terms, right? It's just because those are more expensive. And so that in itself, I think, is going to start to get people to slow where they throw the dollars themselves. I also think that simply all the new ad features that Amazon's offering, there's some really interesting things that they do have. And I think that is we're going to see more of a mix of how brands allocate those dollars. So we might see, like sponsored displays getting a ton of investment from Amazon, for example. That's going to open up a lot more inventory, right? Some additional supply on things where people can advertise. DSPs getting super built out. We've got streaming video now. We've got some super interesting programs that they're doing. And so I think we're going to see more of the dollars still go into Amazon, but they're going to go into other types of offerings that they have.
And interestingly, the countering force there is, my guess is they'll probably start to open up to non-endemic advertisers more and more, right? So expansion in inventory types and bringing in more and more possible advertisers into their advertising realm.
They just had their big push. I saw in New York they'd taken over something, and big messaging push on Amazon as an advertising agent company and not a marketplace, which I thought was super indicative of where they're going.
When you think about the first party data they have and the amount of intelligence they have, it's that segment has to grow. That's just a no-brainer.
Oh yeah, 100%. And there's some interesting things that they're doing in beta, like with one of my clients that might even be able to start tracking other types of sales that happen on other platforms and things like that, which could really start to tighten up the funnel, which is even more interesting for what their capabilities are.
How do you mitigate against these growing CPCs? Like we discussed, there's this double whammy moment about increased shipping costs. Like, what are some changes to tactics, or what are some things that
great question.
we should be doing?
So the most basic one that I always say, and like we do these audits before we take on an account, for example. One of the most common things I see in probably 70% of the accounts that I look at, even brands that are already doing really well, is wasted spend, right? Just efficiency there. And I call that more like the 101 pieces. Like for years, you could get away, with Amazon and driving a lot of spend through like your research batch types, right? Like your broad, your auto, because it was usually cheap enough traffic that even if you spent a lot on stuff that didn't convert, the cost per clicks were low, so it didn't impact you significantly. But when your cost per click, especially if you're like in supplements or an aggressive food space, and now your CPCs aren't $1 anymore, they're $7, $8, $9, $10 a click, right? So the efficiency needs to be as strong as possible. And so that's one of the easiest things people can work on and fix right? Especially just trying to drive as much spend as possible through, actual exact match and ASIN targeting types over time, especially on things that actually convert. And then, reducing your spend towards research over time, especially if you already have winners.
Yeah.
It's a little bit trickier when you're net new, you're in the research phase, and you do have to, spend on some terms to find out what those winners are. But especially if you're on your brand that's been selling for a while, reducing that wasted ad spend so that you can reinvest it into these search terms that actually convert. I think one of the simplest, easiest things that will help, like at least from an efficiency standpoint. Now, in regards to CPC increases, one of the things people don't typically consider is how your relevancy impacts your cost per clicks. And so the inflation that you see on Amazon impacts brands very differently depending on where their relevancy is at for a product itself. So one of the, it's almost a moat against inflation. So we use our ads kind of strategically in this unique way against trying to rank against certain search terms. One of the big secondary benefits, besides the fact that you're getting better visibility on Amazon organically through that, is the fact that you can actually see your CPCs go down over time as you become more relevant to that search term. So like a product that's on page 2 or 3 for a search term compared to the product that's the first organic, they're going to pay different cost per clicks to go after the exact same term itself. And so brands that do have relevancy, not slowing down on the terms that you are already relevant on is a really big key. Like I've been working with quite a few brands recently where they were a market leader, they're market leader for years on some of these search terms, but CPCs went up, they started to pull back on those search terms, and they slowly lost relevancy. So organic rankings would go down. But the other thing that happened is their CPCs against those terms went up really fast. And it's because all of a sudden they're not driving relevancy while these other brands are. And so that kicker there really definitely hurts them. And so one of the things I'm doing with those type of brands is getting their relevancy back, right? So we're spending against some of these terms to achieve some relevancy so that we actually see our CPCs start to decrease or flatline there. So I've got brands that even though we've got this massive inflation, because we protected against it correctly, I actually didn't see inflation on some of those products, right? But definitely, like if you're in the build stage, it's almost a necessary evil right now. So one of the things that I'll do is my CPCs tend to go up initially if you don't have visibility, but that's only because you're going from bottom of search to top of search placements, right? That's where that most expensive piece comes from. But building that relevancy through your PPC or through other means definitely is another kind of really strong way of reducing the CPC inflation, or sometimes you might even see CPC deflation if you're doing it correctly as well. And then the third piece, I would say on that too. Yeah, just one more piece. Use the different ad types, right? You may have great strategy like with your sponsored products, or you've got your sponsored products and your sponsored brands, but with the inflation, those strategies get more expensive. And so being able to go a little bit more wider and just having a more complex ad strategy, I think is also a way of helping to mitigate or kind of guard against that CPC increase. So like implementing sponsored display if you have it before, figuring out how to use that properly. And then I guess I have one last tip, which is combining with DSP has been really helpful. So especially like DSP's bottom funnel, like retargeting customers who viewed but not purchased, or even targeting past purchasers, things like that. That can really help, because if you're driving a lot of spend that's non-branded, through search, which is expensive, DSP, especially in that bottom funnel, can be fairly inexpensive. So that's a way you can blend, a high ROAS and still get a decent new to brand, but also combine that against search, which is really your workhorse and where you're driving the most kind of new to brand focus, at least in how we like to do things.
It's super insightful. Just a quick summary. Number one is just continuous, granular, long tail execution and focus, right? The second point, which is pretty interesting, which is that interdependences of relevancy on CPCs. And there's kind of 2 points in there. One is maintain your relevancy, do is invest in raising relevancy if you're not relevant. So that kind of two different sub-tactics. The third point you brought up is just leveraging all the ad types. For instance, sponsored brand video is probably a little less competitive, maybe compared to other ad types. So
yeah, it's funny you say that because it's like even sponsored brands, for example. I used to really barely invest in sponsored brands because it was always so much more expensive and lower converting than sponsored products was. But now, because sponsored products have seen such inflation, there's certain search terms where it's actually cheaper for me to run the sponsored brand ad than sponsored products, which never ever was the case, right? Yeah. So that exactly to your point, you got to look for more of the gems, and you have to stretch a little harder, than you have in the past.
And then the fourth point, which is the whole audience targeting bit, which is in your case, you're combining DSD with search.
Or even sponsored display.
Or sponsored display.
The retargeting. Yeah, you can do that.
Q4 is here, prime time, although Prime Day is not in Q4 this year. Any specific comments around handling Q4?
Yeah, so I think this Q4 is going to be a little bit of a unique one here. Obviously, we see huge volumes November, December compared to the rest of the year, which is great. But we do have those inventory limitations still. So Amazon's been a little friendly in the last 4 weeks or so on increasing those limits a little bit. But I do have a feeling, a lot of brands are going to run into inventory, just not being in stock at Amazon essentially. So one of the tips that I've had to my clients is concentrating even your inventory focus, against where you're concentrating your ad dollars. Because I've got brands with super large catalogs. One of the gaps we were finding is we're growing all of them, but when we go super wide like that, and especially if they're hitting inventory limits, they keep running into out of stocks, right? And so you're touch and go. And so in that model, your ad dollars become a little bit less efficient because if you're spending to make yourself go out of stock faster, right, you're not going to get the same gain from the relevancy that you would. So I definitely recommend concentrating inventory around products that you're going to really focus on for ads there. And then the other piece is your discounts are honestly pretty important moving into holidays and how you leverage them, and also understanding if you're not leveraging discounts, how do you advertise against that, right? If it's Black Friday, Cyber Monday, you're not running promos during that time frame, probably shouldn't be advertising very aggressively during that time frame because your conversion rate's going to go down. If you are, let's say you've got lightning deal scheduled or 7-day deal, that's when you do want to go ahead, start getting aggressive, on the PPC front. And especially when you do have those deals, gives you a nice bump in conversion rate. So especially with these more expensive search terms and the inflation there, leveraging deals is a great way to be even more efficient with your ad dollars over time by impacting the overall conversion rate there.
Yeah, great tips for Q4. And also, Daniel, I can't wait to see the earnings report come out. I think that's next week, just to see what their guidance is going to be. So if there's one piece of advice that we would have for anyone viewing this, what would that be?
Yeah, so for me, it would be around just make your ads as efficient as possible right now, especially with the CPC inflations. So ads I find are usually the area that has sometimes the least amount of deep dives and oversight. Sure. People look at the whole business, but there's definitely a lot of hidden gems in there. And so whether you're doing it manually, if you are doing it manually, make sure you're doing it frequently, right? And so you can catch these things as quickly as possible. Leveraging some technology can definitely help you to be, as efficient as possible. I'm sure Srinath could definitely speak to that in high detail there. But yeah, try to be as efficient as possible. You just got to be. I think of my dollars as opportunity cost, right? And so if I'm spending the dollar here, it's an opportunity cost on me being able to spend the dollar somewhere else, right? And so if there's places that are search terms or product ASINs that are really working for you, drive as much as you can through those, and really try and reduce down, some of that wasted spend, those inefficient search terms, because ultimately, that's the way you're going to be able to grow and try and keep it profitable, with the CPC inflations happening at the same time.
Well, this has been great, Daniel. I guess we'll end on this note. Thank you for your time, and for
Awesome.
everyone viewing this, thank you for watching.
Thanks for having me, Shrina. Appreciate it.